Good afternoon, ladies and gentlemen, and welcome to the Music Magpie PLC full year results 2022 investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company would be most grateful for your participation. And it gives me great pleasure to hand over to Steve Oliver, CEO. Good afternoon, sir.
Hi, Mark, and thank you for the introduction. I will also go on the poll to collect the fact that I'm a shareholder, so I will promise I'll do that before we finish. Welcome, everybody, and thanks for joining us on this very cold and snowy day. You can probably see outside the sprawling Stockport metropolis has got a sprinkling of snow on top of the NCP car park. So glad we're all indoor and warm. So welcome to the first of these. I should probably just precursor by saying it's the first time we've used this technology. So please bear with us a little bit. If anything goes wrong, we're used to good old-fashioned Zoom by now. So we're really hopeful of this because it looks very clever. But we'll do our best for it. But welcome, everybody. Thanks for joining, as I say. We're going to try and cover a few slides. I think we've got 20 in total, but we'll try and rattle through them because really we want to get to the Q&A as quickly as possible. We do appreciate that we're here to answer any questions you've got, so we'll try and get into the Q&A as quickly as possible. We're going to do a handful of slides each. Obviously, we've got some operational highlights, some financial highlights, but we'll perhaps just start with a little bit of an introduction. I thought, guys, we might do it in the style of Vic and Bob. So if I introduce myself, hello, I'm Steve Oliver. I'm the chief exec and co-founder. So I literally co-founded the business 16 years ago now in my garage in Stockport. Fair to say it's changed a bit since those days. As the name suggests, we were very much CD and DVD and games and books in the early days. But as you'll hear, mainly us talk about now, we are mainly consumer tech is our dominant category. So Ian, do you want to just say Vic and Bob style hello and who you are?
Yeah, hi everyone. So Ian Story, so Chief Operating Officer. So I've been with the business for 10 years now. I was CFO up until the point of IPO in April 2021, when I became Chief Operating Officer then at that time. And I'm joined here by our new Chief Financial Officer, Matthew Fowler.
Hi everybody, Matthew Fowler. As Ian said, I joined CFO and I've been with the business just a little under a year now. Thank you.
You scored 4 out of 10 for the Vic and Bob impression, Max. At least you put your hand up, unlike Ian. I'll just quickly introduce our non-execs. Martin Hallowell, some of you may know from Softcat fame, one of the superstars of the main market over the last few years. Martin was CEO and then chair for many years of Softcat throughout their astronomical growth. He also does Team 17 and Raspberry Pi. Alison joined us also just before IPO as our head of Remco. She's done Xar and Norcross, amongst other things. And Dave Wilson, again, fairly well known across the AIM market. Another superstar AIM placing actually in GB Group that Dave was both CFO and COO for many years. More recently, since he's turned non-exec, he's also non-exec chair of Lad Bible. So we really enjoy working with our board colleagues. No, we genuinely mean that. They brought great wisdom and support and challenge to us. So we enjoy working with them very much, and clearly a very experienced team around us. So the first slide, I guess we came up with this phrase for the first time during the pandemic. And I think, most viewers will know and I wasn't particularly comfortable with this phrase at the time, but we were a winner. We were a beneficiary of the pandemic, and we positioned ourselves very much as being here to help. So I have a retail background. I grew up above a small retail shop that my dad owned. And the first thing I guess my dad installed me in a retailer, and now as an online retailer, is you should always be there to help and here to help. And the why of our business is that we are here to help. Why do we exist? What are we here to do? We're here to help. Well, what are we here to help with? 2, I guess, challenges in life. Being a consumer champion and answering some consumer questions, and then environmental in being smart for you, smart for the planet. The smart for the you, we're here to help consumers easily raise cash in a fast, trusted and convenient environment. So our biggest challenge is actually persuading them to do something, because they're rather apathetic in a lot of cases. Only 20% of consumer electronics is currently recycled. We're on this revolution, this journey to try and get people to get it out of their drawers. We've paid £400 million out in our history to both UK and US consumers. And we'll talk about how we're trying to make that even easier, even more convenient, even more trusted via our kiosks in particular. We're also here to help consumers save money. And this again has been over the 16 years how we've positioned ourselves. Raise cash for your old stuff, save cash when buying stuff. And Martin Lewis has covered us extensively over the years on Money Saving Expert as being a great way to save money. And here's the key bit, to do it in buying refurbished tech and media with absolute confidence and trust in who you're buying it from. You're buying it from somebody who's got a Trustpilot rating of over 250,000 reviews now, and the winner of the What Mobile Awards for 6 years running. And as the bottom left credential says, we are also, and slightly surreal statement, but it is actually true, we are the biggest seller in the world in the history of eBay and Amazon. So globally, in the history of both eBay and Amazon, we have more transactional history than any other seller. So even if you don't think you've traded with MUSICMAGPIE, you may well have bought from us on one of those platforms. And we have significantly more than 10 million positive reviews on both of those platforms. And I guess then here to help also, more recently, and we're going to talk a lot about this today, with our disruptive, flexible rental products. So the monthly subscription, not just offering a phone to sell for sale, but also on a monthly subscription. Now that starts at £6.99 a month. We're going to give you some more information on that. More typically, it's about £20 a month for a device that's maybe 2 years old now. So we do offer new products, an iPhone 14, anything up to that, but we go back to iPhone 7, sweet spot being around the iPhone 11 or 12. But we also do it on consoles, tablets, wearables, AirPods, etc. And then the smart for the planet credentials, if you like, along the bottom. I've already mentioned we bring the circular economy to everybody. We're trying to, really make this a mainstream activity. I think, we reflect on the fact that we've always been a recycling business, but nobody really seemed to care about that too much until a few years ago. But actually, the world has woken up to the importance of the planet. I think the pandemic accelerated that. And we are really trying to emphasize and educate consumers, reducing waste. We give 400,000 consumer tech items a year a second life, and still we give over 10 million media products a second life. So that's CD, DVD, game and book, which is still, and I'm going to cover this in a moment, about 30% of the turnover of our business, consumer tech being 70% of the turnover. Just a quick little carbon calculation. Excuse me. This is based on the fact that it's been independently verified in a study that preventing a new iPhone from being made by giving a refurbished one a second life saves just over 50 kilos of carbon. If you multiply that up for all our categories, including media, we save just shy of 50,000 tonnes of carbon with our recycling services that we're bringing to both consumers and now corporates. We also very proudly contribute to our local community. We're heavily involved in a new homelessness charity that's operating in the Northwest as an example, but it's always been very close to our heart. And during the pandemic, we made very sizable donations to NHS, etc. So always been close to our heart. Our second introductory slide is just our circular economy. It's our wheel. I won't dwell too long for this because I'm sure many of you do know the model, but basically the right-hand side covers the sell journey, the recycling journey, get cash for your stuff. What's the difference between us and, say, eBay? Some of you, if you've read anything I've said previously or heard me even, may have heard me use the phrase lazy man's eBay. Many people want to buy off eBay. Not as many people can be bothered selling. 80% of the UK population won't. So you can get a fixed valuation from us free logistics. We come and pick it up from your door, or you drop it off, and it's a fixed valuation. When it arrives with us, we do a thorough grading check. As long as it was what you said it was going to be and in the condition it was, we pay you instantly on the day it arrives in our warehouse. That is part of our consumer champion promise, that we're helping you raise quick, convenient, trusted cash. We take ownership of that inventory. We refurbish it, whether it be in the old days with CDs, DVDs and games when we were just that business, or now a more complicated refurbishment process. We do a 70-point quality check, obviously ranging from the simple ones of a battery check and change if necessary. We change more often than not the battery in an old device that's been sold to us, because it's often the problem with the device that inspired the seller to change their device. But we offer a 12-month warranty on anything that we are reselling or re-renting. It was only yesterday that we noticed, so I'm now at 1:45 on the clock. That's not a cricket bat leaning on the phone on the left-hand side. It's a screwdriver, although our screwdrivers that we refurbish our phones with are rather smaller than that, but we didn't have time to change the graphic. But that is what we are doing up the left-hand side, reselling, re-renting. Over 95% of what we buy on the right-hand side gets refurbished and resold on the left-hand side, or re-rented now. It does beg the obvious question, what happens to the other 5%, Steve, before somebody puts it in the Q&A box? The other 5 gets broken down for parts, mainly harvested for parts. Any little bits and pieces left over are all recycled responsibly, and we're fully waste compliant. And part of our sustainability, as an example, is that not a single piece of our packaging that we use in our business ends up in landfill. We reuse everything out of that process. So I hope that gave you a decent overview. Just some operational highlights we are here to talk about our results, so forgive me for those people who knew most of what I've just said. We've made some really strong progress in the last year operationally. I'm going to start with our rental offer, because we want you to really learn and understand and really get to the heart of this rental offer, because we do see it as our key differentiator in the marketplace. It's offering great value, great circular economy credentials. We've got 30,500 subscribers to it as at the year end, but then also we give the up-to-date figure from 9 days ago of just over 36,000 subscribers now, giving us a committed order book. There is a slide on each of these, so I'm just going to touch on the highlights of each. We'll tell you a bit more about 24-month contracts that we've introduced to sit alongside 12, and also some of the corporate work we're doing. Kiosks, I think I touched on just in the introduction. Again, there's a slide on it, but this is our smart drop kiosk that sits in just shy of 300 Asdas, that you can sell your old device in 2 or 3 minutes, raising cash instantly. You get paid instantly. And they are now rolled out across the Asda estate. We've paid out over £10 million, and we'll give you a bit more detail of the next steps of development on those. Growth on third-party platforms. I think 1 or 2 people got quite concerned about just that post-IPO, about Back Market. It's a French marketplace, and I stress those words, marketplace. It's not a retailer. It doesn't hold stock. It doesn't refurbish. It doesn't resell itself. It hosts sellers like eBay, like us. So we joined Back Market. We've become one of their biggest sellers over the last year on both the UK and the US. So if people want to shop via Back Market, they can still purchase through MUSICMAGPIE. Equally, the market responded reasonably well recently in January to our announcement that we were selling on Walmart, the biggest retailer in the US. They have their own marketplace. We've launched both our media products and our tech products. And we do make reference, and Matt will come back to the cash flow and the financials on the 30 million 3-year committed revolving credit facility that is powering in particular our rental offer. I'll just steal perhaps 2 headlines of Matt's financials that we are going to come on to. We have reordered our deck slightly, actually. If you have seen it elsewhere, in the usual deck, we do the financials next. I'm just going to run through the strategic elements. Ian's going to tell us about rental, and then Matt's going to come in with the details of the numbers. But just for now, a couple of the highlights. Consumer tech, great growth in the year, up to 96.6 million in the group. One thing we don't say, I don't think, in the deck is our sales UK to US. It's about 78% in our UK division, the main MUSICMAGPIE brand, 22% in our Declutter US brand, which is based in Atlanta, Georgia. But great overall growth in our tech sales. That's driven by both outright sales growing by 9% and also an increase in our rental revenue. And then I will just draw your eye, and amongst the other numbers, Matt's going to give you the details of it, to our adjusted EBITDA delivered to market expectations of 6.5 million. And we'll tell you more about that and the breakup of that as we get into it. Tech going well so far. I have literally, I think, one slide or maybe two on just the couple of the key strategic initiatives. So actually it was Ian post-IPO who we talked about the fact that actually our story is more complicated to tell than you might think. And actually I think we were guilty at times in the IPO of pebble dashing a little bit and trying to tell everybody everything about our business. So we simplified it into 3 strands. Our key strategic growth is going to revolve around buy more, sell more, rent more. That's what we do. We buy from consumers mainly. We do buy from some corporates as well and some wholesale, but we're a C2B and then a B2C as we sell it and rent. But we can't sell more and rent more unless we buy more. So no coincidence that a couple of the key buy more strategies centered around buy more. We'll start with the kiosk that I've mentioned. The kiosk provides an even faster and easier way. So I guess we looked at ourselves 2-3 years ago and said, we've become the UK's biggest recycler. How can we disrupt ourselves and make it even easier, even more trusted, even quicker to sell to MUSICMAGPIE? So we launched our Smart Drop kiosk, which is on the right-hand side of the image there. It offers fast cash for consumers, money transferred to bank account. Of course, the retailer hosting this loves this because it's giving their customers cash in their pocket that they can pay for their shopping that day with. It's trusted, it's easy. You would put your phone in the middle in that inspection hatch. We have a technician dial in to review it, do the security checks on it, some simple diagnostics and the cosmetic grading of it. At any stage, the consumer can accept the offer. The device slides back into the storage unit and gets paid. If they change their mind or decline any revision to the offer, which we try and minimize the instances of that, they hit decline, the door opens, they get the device back. So this, where we are up to right now is we rolled out, finished in October, rolling out across the Asda estate. They tell us that 90% of the UK population is now within a 15-minute drive. Actually, I think it's the third bullet that then refers, and we'll come back to the second one, about other partnerships being discussed. We get asked a lot, are you exclusive with Asda? The answer to that is yes, we are with grocers verbally. We are committed to our Asda relationship and partnership, which we very much enjoy. I think there's more to come from it. But we are starting to think about alternative locations, high footfall locations for where these kiosks could do. And we've actually just installed our first one in a shopping centre. For those that know the Trafford Centre, fairly local to us here, we are in there. It's actually become our most visited kiosk already within the first month. So we're talking to other potential hosting locations who can complement and supplement Asda as a host. But those couple of key stats, we've paid out over 10 million. Here's perhaps a more powerful one. The kiosks are now responsible for bringing in over 40% of our devices that we're buying are coming through a kiosk. Consumers really like the convenience and trust of selling through these. Really interesting. The average purchase price through a kiosk is higher than a traditional MUSICMAGPIE transaction. That doesn't mean we're paying more for it. It means that the average quality of the devices and grade, so people are selling the more recent ones for higher value because of the convenience and the trust. What we're now doing with that, we're doing some measures to improve the gross margin on what we bring through from our kiosks. So testing one or two different elements of, will people pay a small fee for instead of having to post it off and wait for a couple of days, will they give us a small admin fee? for the pleasure and privilege, as the Smiths sang, of depositing their device in a kiosk. And I guess what we are seeing very much is, I mentioned before, we're a counter-cyclical business. We service distressed consumers. We grew up in a recession. I started the business in a recession. We have prospered when people are looking to raise cash, and our buying is strong. If you hear from any re-commerce or circular economy business, their CEO is very likely to tell you they are supply restricted with what they're buying. Historically, that would be true with us, but our kiosks are really starting to service and buy from new people. This is making this a mainstream activity when you're putting it in the faces of 30 to 50,000 shoppers to every Asda every week. So we're really pleased with the progress of our kiosks. Quicker word on Sell More is our store is our biggest channel, certainly for our tech product. We grew up and we scaled the business. I mentioned before, we're the biggest seller in the world on eBay and Amazon. We did that nearly entirely with our media sales. So people buying thousands, millions of CDs and DVDs and books and games from us. But actually our tech sales now, it was 80% last year. It's the year before, apologies, 70% last year. As we started to scale more on back market, Amazon opened up their FBA program for B and C graded product, and we started to do more of that. That's actually just started to nudge back the other way this year, and it's our absolute focus is our own store. We want to sell to consumers on our own store. We form a direct relationship with them, and frankly, we don't pay a commission to the platform for trading with them. So that is absolutely, and as we come on to the rental offer in a moment, that is where we do all our rentals. We don't do any rentals on platforms. I think I've covered the bottom points. Previously, we have launched on Walmart. That's a really exciting potential partnership that we've started with selling on their marketplace, both media and consumer tech products. But we do use the platforms to trade flexibly, trade our end-of-line product, etc. And if there's a coupon on one of the platforms, we'll use that appropriately. I think we're going to go on to our rental offer. I'm going to hand over to Ian, mainly because I've run out of breath, but also Ian lives and breathes our rental offer. So he's going to tell you about the rental offer. I think if we can get the technology to work, we've got a video leading into that, just to introduce our offer. So I've always wanted to say this, roll the video.
The best tech doesn't have to cost the earth. It's time for a smarter choice. With MUSICMAGPIE, you can now rent refurbished and new phones. And we have loads of other tech too. When the cost of living is going up, keep your phone bill down. With iPhones from just $6.99 per month. And free yearly upgrades, all with lifetime warranties. In your face, overpriced phone contracts. Join the rental revolution with MUSICMAGPIE. Smart for you, smart for the planet.
Hope that gave you a good idea of the offer. I'll hand over to Ian to take us through our rental offer.
Thanks, Steve. So yeah, as we've got on the slide there, really, sort of our rental subscription model is really sort of our disruptive solution to provide that more affordable and flexible option to people who maybe haven't got that £300, that £400 to basically sort of replace a phone today, or equally are buying for kids, which we do see a lot of our customers look to do in terms of their kids' first phone before they potentially go for high school. I certainly did that with my boys at a much cheaper cost. So the examples are, a £300 phone in terms of a purchase can rent that for, as we've seen there, sort of as low as $6.99 in terms of some of our product range. The benefits of this subscription model, it provides a high quality recurring revenue and EBITDA performance and builds that regular interaction and deeper relationship with our customers. And really this was born out of the fact that, what we saw through our data is that customers typically were changing their device once every 2.5 to 3 years. So this gives us the ability to continue to earn items and earn revenue and profit from that device throughout its useful economic life whilst holding on to that device, as well as being perfectly aligned to take advantage of the growth in that subscription economy and the way that people are seeking to acquire things now. From an accounting perspective, so we get the recurring revenue and cash flow stream that underpins our future earnings, and we'll talk you through the stats later on as to how that's built a nice forward order book to underpin our earnings. We recognise the revenue straight line on a monthly basis over the duration of the agreement, so when customers are paying that monthly rental fee. And as I said before, we retain the ownership of that device, so we're putting those devices on our balance sheet and we're depreciating those over that useful economic life of that device. And certainly what we see in our unit economics that we'll move on to in a second is that we can earn higher revenue and EBITDA over the life of that device. But we do recognise there is a short-term suppression in terms of that revenue growth that we would see from a firm sale compared to that rental. We've sought to illustrate that on this table in this example, which compares in the first column there, a firm sale. So this is, you'll see on the right-hand side, there is an Apple iPhone 12 64 gig that's available on our site to buy for $409.99, including VAT, or rent for $18.99 a month. So if we just go down the table on the left-hand side, that $409.99 converts to a total revenue net of VAT of $387. The product cost, we've paid a consumer £283 for that item, which therefore then goes through our P&L, which after some transactional costs and marketing labour costs will today earn us an EBITDA of £68. Compare that to a rental offer, and we put in there a rental day one, because actually in rental day one, because we only get that £16 advance rental net of VAT, against some of the costs for credit checking, carriage out, etc., and the marketing labour costs for putting that phone out there into the market, we actually do lose money on the first day, and we lose £25 there from that EBITDA. But as you will see over the 12-month period with the right column, we're actually then improving that so that over the 12-month period, we've earned £149 of EBITDA from that one device, with further still to come post that 12 months compared to the 68 that we earned from a firm sale basis. And that equation breaks even after 7 months of that contract. So certainly you see in the first half of the year, us being able to accelerate that rental offer is earnings accretive for us throughout that first 12-month period. We then, in terms of the accounting, depreciate that asset below the line, so that comes through then arriving at that EBITDA, and we depreciate things on a 33% reducing balance basis, with new devices having a useful economic life for about 7 years, and us assessing the useful economic life of that as we go through the various grades and generations of those devices. Just some key statistics then to bring you up to date in terms of our rental offer. So Steve mentioned we've got 36,000 active subscribers as at the end of February, at the end of our Q1. Our average sort of monthly subscription per device is £20 and remained about that level sort of since we first launched the product back in October 2020. And you'll see there the graph on the left-hand side, how this is built over time in terms of our monthly revenue contribution that we're getting from that book, that now 36,000 book. Building to 575,000 in monthly revenue by the end of February, and the monthly EBITDA before central overheads contribution that comes through there on 450, which all of that allows for a forward contracted order book that we've currently built, looking forward of 3.7 million of EBITDA as at the 28th of February. And then Matt, perhaps if I can pass over to you for review of the numbers to November.
Okay. Thanks, Ian. Yeah, I've just got 4 slides here. I'll start off with a look at the segments, then the consolidated income statement, then we'll move on to the cash flow. So starting with consumer technology. So we split this down into 2 subsections. So outright sales and then our new growing rental proposition. So a top level segment growth, 12.2%, up to 97 million from 86 in the prior year. And underneath that, I'll start off with outright sales. So good growth here in outright sales, 8.3% year over year. And that's very much supported by the performance on our third-party platforms, which we expanded midway through 2022 to include back market. And Steve's already talked about platforms and how they fit into the mix with store. And post year end, we also added Walmart. So up to 4 platforms now to support our store. Second split we have on consumer tech is rentals. Obviously, Ian's just talked about the rental proposition. In terms of numbers, so grown from 1.8 million revenue to 5.3, and the subscriber a net gain of 17,000 accounts to year end, and then 23 if you include the movement up to the 28th of February. So real critical mass now there in that rental model, and with a much higher gross margin, real profitable, real material contribution to the group. Just a quick mention of margin. So margin for consumer tech, consistent, well, actually static at 20.9 in H1 and H2. So happy with the stability of that margin. But beneath that top level, just to make a comment on the trend underneath. So obviously the increasing mix of rental, which is high margin, is just able to offset the reduction in gross margin and outright that's being caused by the mix of platform sales. And what do I mean by that? So to actually trade on a platform, there is a small fee, so in the region of 8 to 10%. Therefore, like for like, the gross margin on a platform will be 8 to 10% lower than our own store. However, if you're on a platform, you're on there trading off their brand and their marketing, so you get a much lower marketing spend yourself. So net margin wise, substantially the same margin from both platform and own store. So in summary then, 2/3 of group revenue and growing, stable margin, and rentals that large increase to year end and post year end. Moving on now to our second segment, so This Media and Books. So this is our legacy category and has been a sunset category almost. It is in decline. The headline is unfair, headline decline, because we're comparing against a COVID comparative in 2021, and the segment was a beneficiary in the first quarter of strong COVID-related sales. So what we've done is split this down into halves, so half on half, and as you can see from this, the sales decline around about 5% per half, annualizing to approximately 10%, which we consider to be much more normal going forward. Despite that sales decline, I'll draw your eye to this gross margin, so very robust, 37%, and also in the bullets there you'll see we're making a point that very limited marketing. So good contributor to GM with minimal marketing spend and minimum management resources. Okay. Pulling those two together then, we'll move on to the income statement for the year. So at headline, virtually no change in revenue, but as we've just discussed, we have good, strong consumer tech growth compensating for that This Media decline. Moving down through the P&L, gross profit of 38.1 million and operating expenses down approximately £500,000 from the prior year to 31.6. And this reduction is owing to cost control and also with a reduced spend on marketing, reducing from 5.5% of revenue in the prior year to 4.5% in 2022. And with the mix in consumer tech, which I also mentioned takes a higher proportion of marketing, despite that growth of this consumer tech, managed to control that marketing spend to bring us down to an EBITDA of 6.5 million. Underneath EBITDA, we've obviously got depreciation, amortization, impairment, 6.6 million, up from 3.6 in the prior year. Of this 6.6, dominated by 3.9 of depreciation, and within that 60% or approximately 2.5 million relates to the rental assets, which is obviously a key feature of our investments in 21 and 22. Moving down below depreciation, interest charge, which includes under IFRS the interest portion on lease properties, but also within there an increasing element relating to our revolving credit facility that is being drawn and used to fund the rental assets. So that gives us a LBT of 1.1 million and a reported loss of 1.5. Finally then, just moving on to the cash flow. I'll draw your eyes to the top section. So adjusted EBITDA of 6.5, translating to an operating cash flow of 6.2, meaning very good cash conversion from that EBITDA performance. Looking at the components of that, you'll see working capital is a 1 million inflow. And that's despite on the balance sheet, you'll see a 800,000 increase in inventory year over year. Point of detail, but the movement to kiosks, so we pay our customers immediately, same day, and then there's a bit of a lag as we wait for those phones to be collected from kiosk and brought back to our warehouse. So that increase in inventory pushed working capital up, but was mitigated and improved upon by good performance on debtors and creditors at year end. So this was related to tight management, but also helped with an extremely strong Black Friday week. Below operating cash, again, domination, CapEx and IT development spend. So that CapEx number, 6.6 million spent on rentals, up 3 million from the 2021 number. Just shows the amount of assets that we're putting on the balance sheet, and that increase of 6.6. Underneath CapEx, you'll see the lease liabilities and finance expense. So investing and financing outflows about 16 million. So when added to the 6.2 operating cash, you'll see a change in gross cash of 10 million approximately. We had opening cash of 1.8 and a consumption of approximately 10, which means our closing net debt was 7.9 million. We mentioned the revolving credit facility that we signed in July, so 30 million. Obviously has 2 covenants on that, main one being leverage. So our leverage covenant 1.3 at year end. Okay. So in summary, good growth in consumer tech. Rental subscriber numbers are material to us now and continue to grow, and good cash conversion from operations, which we're using to help fund the investments in the growing rental assets, along with increased drawings on our RCF. So I'll hand back now to Steve for our final summary slide, and he can give some closing remarks. Thank you.
Thanks, Matt, and thanks, Ian. Very quick wrap up from me to get into the Q&A. I hope you can sense today that we've got a very clear vision of where we want to go with the business, with this buy more, sell more, rent more. We're continuing to position ourselves as here to help those consumers who do want to sell to us and raise cash, and also buy from us and now rent from us. It's a tough consumer environment out there. We all know that, cost of living crisis, but we have prospered, we've grown in difficult conditions, and we are counter-cyclical with our consumer champion model. We're leveraging the smart drop kiosk to make it even more of a mainstream activity to recycle your old device, to raise cash, and there's work to be done on partnerships with the kiosk and how we interact with consumers who use it. I think you've heard today, and I have noticed a little, I think it was a pre-submitted question about the store. Just to stress again, it is our big channel. It did decline from 80% to 70% in the last year. It was a natural effect of the platform extension, actually. I suspect that will nudge back over the next year because very much it is our absolute focus as a sales channel. We're looking to constantly optimize and make that store even better. I guess this next bullet is the crux of the challenge, if you like, that myself, Ian and Matt talk about literally on a daily basis, and that's balancing our rental growth, which is building that medium long-term growth in our relationship with consumers, but also those earnings and high quality recurring revenue and EBITDA versus the impact of that substitution on a sale, where, as Ian showed us on that day one comparison, we swap a £400 sale and an £80-ish EBITDA for that month one loss. So that is the future of our business. It's our key differential. It's our key value proposition for both the consumer and indeed shareholder value as we continue to grow those earnings. But we have to balance that in terms of driving the short-term performance that we know the market wants to see from us, but also managing the cash equation appropriately. So believe me, that is our hottest topic in the business, about how we manage that. But if I could summarize buy more, sell more, rent more into just one of those, our future is very much around that rent more monthly subscription offer. Part of that is the corporate proposition. We haven't talked much about that in the presentation. Frankly, we didn't want to blur the story too much, but we do some really good stuff and increasingly interesting stuff, both in terms of recycling devices. So we service, as an example, Deloitte with all of their old devices that now recycle and are sold into us, that we refurbish and resell. But also we're working with a network management company in particular, Utilizer, a wonderful partner in building some great partnerships with corporates to sit the handsets alongside the network and the airtime. It's very much on the agenda that, again, a little pivot for the businesses. We've always been a consumer-facing business, that we add corporate into that mix more and more. And I think my last point is just to stress, if it needed stressing, I am the co-founder. I've been here a long time now. It's because I love it. And I've never been more excited and passionate about Magpie's future. With the team around me that I've got and the opportunities we've got, I was just telling somebody before the call, we've never had more opportunities. We've disrupted ourselves again with our kiosks, with the corporate work, and in particular with our rental offer. We remain well invested. I am the biggest single individual shareholder in terms of human being. There's one or two bigger of our institutional friends who are on the register with us. As you will have seen, both Ian and myself have been back into the market to buy more this year. We're absolutely aligned in creating shareholder value. I've got nothing against hired-in CEOs who are on a salary and bonus, but I'm more than that, and we're very, very invested. Hopefully you can see intellectually, but we're financially invested and absolutely emotionally invested. So I think we have had a question already from Wayne, who I do read your occasional comment, Wayne, and I know you have concerns about this. We are absolutely invested in the future of the business, as I say, financially, intellectually, and emotionally. Nobody cares about this business more, and we're very, very focused on what we're doing around those three: buy more, sell more, and in particular, rent more. On that, I think we'll get into the Q's and A's.
That's great, Steve. Thank you very much indeed, and to Ian and Matthew for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab just situated on the right-hand corner of your screen. Just while the guys take a few moments to review your questions that you've submitted already today, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Matthew, if I may, you can see you've had a number of questions from investors, so thank you firstly to everybody for your engagement this afternoon. If I may, Matthew, hand back to you, and if I could ask you just to read out the questions, and then if I could ask you to moderate those as appropriate.
Okay, thank you. So start off here. So I've had quite a few questions come in, so thank you very much. Nick B, Smart Drop looks really exciting opportunity. What is the planned rollout here, and what capex is required to support this? So Steve, I know you covered this briefly, but perhaps you could expand there for Nick.
Yeah, we agree. It's a really exciting opportunity. We do think this is just bringing the recycling of devices and making it even easier and more trusted to the masses in the foyer of a supermarket. I think we are experiencing that halo benefit. We're doing a lot of work with Asda about the positioning of the kiosks in stores, which stores they're in, and then, as I mentioned, actually looking at other host locations for them. So in any high footfall location, whether it be a shopping centre like the Trafford Centre that we've done, or any other hosting, we'd like to try and find some town centres, etc. But yeah, we don't see a huge amount of capex. We may need to top up the estate. We may move one or two around in the estate. But I think, Matt, you covered in the cash flow that we've spent 2 million on our kiosks in the last year. We don't see anything like the repeat of that capex in the new year. This is about really optimising and making more efficient the kiosks that we've got and the estate that we've got, and looking at new opportunities.
And just reading down as well, I've got one from Chris T, sort of follow on or related. So how's the relationship with Asda going? So not just the kiosk, the wider relationship.
Yeah, it's a great question, because it is much more of a holistic relationship that we have with Asda. It's a number of fronts. We use Asda to you as one of our main courier partners. To people's great surprise sometimes, they launched about 2.5 years ago in 20 stores our old media products, so CD and DVD for £1 and £2 in their stores. They launched it in 20 stores. It's now in over 250, because their customer base is very much still buying that product. So we're successful partners with that. We have an online affiliate relationship with where they partner and promote our services to their consumers. And as you say, we've got the main Smart Drop. So more to come from that. We are in active conversation with them, and it is a very healthy. They really respect the brand. They have done from the start. They know that what part our brand plays in trust, people trusting the circular economy with Music Magpie. So more to come from that, but a very holistic relationship and a very healthy one.
Okay, thank you. Ian, I've got a few questions here related to rental, so I'll probably a few quick fire ones, but I'll read them out, then you can answer. So first of all, James is asking, what's the expected life of the average device? And is there an expectation that the devices are sold when they come to the end of their rental period? And also, what's the target demographic of the rental customer?
Okay, so the average life, we tend to operate within about a 7-year spectrum, as I said, in terms of that useful economic life. And typically, it's when Apple stopped doing effectively the security patches for those devices. So I think we're right on the cusp now of sort of iPhone 7 starting to fall out of that now. Up to, we do rent sort of those iPhone 14s and those brand new devices. So over time, we will effectively see that come through. We'll get various devices come back that we will purchase them throughout that economic life cycle, which we can certainly do. Always have some perceived value at the end of that as well, which we can then sell and effectively move on or re-rent again to another customer. Target demographic, it's an offer for everybody, really. I think we've probably skewed it a little bit more towards the younger demographic with some of our marketing over the course of the last quarter. We've done a lot of TikTok type work with sort of the video that you saw there previously. But it's really an offer for everyone who just recognise it as a more cost-effective way of acquiring a device.
Okay, and actually I'll stay with you again for this next one, Ian. So do you manage all refurbishments internally, and how do you find recruiting experienced technicians?
We do manage them all internally, so we've got a really nice sort of repair space over at our sort of warehouse and distribution centre about sort of 5 miles away from here. We're actually also training our own staff up as well currently. So people will typically come into our tech department as a grader to assess sort of conditions of devices. And we're effectively investing to upscale those towards doing sort of more complex repairs effectively over those devices. Repairs is a really important activity for us to enable us to really sort of upscale those devices, squeeze that margin out of it as well as providing a great quality product to the customer.
Okay, thank you. Steve, I'll probably push the next couple to yourself. So what are the plans for US expansion? Walmart, I believe, own Asda, which may help you.
Yeah, they used to, didn't they? It is now privately owned, although they're still using a lot of the Walmart systems, and I think there is quite a close relationship between them. Look, what Walmart is an exciting partnership opportunity between the businesses, and I'm sure it was helpful that we were doing such interesting stuff with Asda. We've launched, as I mentioned before, our media products on there and are selling those successfully already. And literally tech has launched on Walmart Refurbished Tech platform in the last couple of weeks. So that's a really interesting one. We're aware, I guess, as part of that, what I mentioned before about pebble dashing the story, we don't talk about the US a great deal. And that's not because we're not excited about it or we're not bothered about it. But it is slightly in the background whilst we're focusing and developing on the key growth initiatives of the kiosks, the corporate, the rentals, etc. And very much the plan is to take the learnings, take the understandings, look at the partnerships we've formed and look to replicate that in the US over time. It's not in the immediate plans. As I mentioned before, the US division is just over 20% of turnover. Matt, you should know, you gave me that number. But it isn't a huge, a few years ago, the US felt like our equity story. It's not just that now by any stretch, although what I will just leave us with is the market over there is 4 times bigger, as it is for most things. The US market is 4 times bigger. It's slightly more nascent and immature in nature in terms of people splitting their handsets from airtime. Most people do a deal on a lease purchase with both together, but overall the market is 4 times bigger. So it's a great opportunity. It's a division that positively contributes for us, but it's not our primary focus at the moment.
Okay, thank you. And a question come in here that says the percentage of store sales has dropped from 80% to 70%. Is that a concern? Now, I know you covered some of this in the deck, but perhaps you could just expand a little, Steve, as to what that actually means for us.
Yeah, I think I tried to cover it after with the comment about, some of that was just a natural Walmart coming into the mix, back market coming into the mix, etc. They all play an important part in the sales strategy and mix. If people, many of our viewers, I'm sure, will have seen back markets adverts on London Tubes, etc. They are a marketplace. They were very keen to get us on their marketplace. We are the biggest and the best recycler of refurbished devices and most trusted. So they really wanted our inventory on the platform. We went on there. We have become one of the biggest sellers. But we won't be busy fools. We won't sell our product and pay their commission and drop our margin when actually we can sell it on our own store, which is our primary focus, form the direct relationship with the customer, and now, of course, offer that rent as well as outright sale options. So as I suspect, I said before, I suspect that over the next year, we'll see that start to go back up again. And that is a focus for the team.
Okay, Steve, I'll stay with you. I've got another question on kiosks. They're coming in, so I'm sorry I haven't kept these all grouped together. But what are the commercial terms with Asda, or is it simply a value-added proposition for their customers? And do you have to pay Asda a fee to occupy the store? So I guess we won't go into terms, but could you give us an overview of what's in it for Asda, what's in it for us?
Yeah, to be inappropriate to talk about commercial details, but yes, there is a commercial agreement. Of course, we did sell the virtues, and actually they understood it very easily and comfortably because it was one of the reasons they came to us to talk about what we could do together. The virtue of putting money in their customers' pockets that actually doesn't even pay for that week's shopping. In theory, the average purchase price is about £250, which pays 3 or 4 weeks' shopping bill. For the average customer. So, and it's also bringing in younger people into their stores because they're generally more the people who are selling their old device, and slightly more male bias customers than their own, which is both really interesting for them. So there is a wider indirect benefit for hosting these kiosks. We showed the picture of it before. It's a metre square, so it's taking up space that wouldn't normally be, taking up sort of cash machine, and where people used to pour in their money jars, etc., in the foyer. So they're very prominent, very displayed. But yeah, there is a commercial arrangement. Of course, you wouldn't expect anything less, but it is a wider benefit to them.
Okay, thank you. There's one come in here from Ollie that I'll probably take myself. So what is the target figure for the number of subscribers year ending 30th of November 2024? Well, we actually don't publicize a specific number or target. We have our financial estimates out there and a note available on our website, the Edison note, where you can see the financial number. However, in arriving at that, I think if you were to take a reasonable pro rate of our performance in the year and extrapolate that out to November 24, you'll get a pretty accurate view as to where we would expect to be given those current financial forecasts. Another question for Ian here. Probably don't need all the details, but perhaps you just give an overview for Roger. What's the procedure if a rental device under warranty breaks down?
Yeah, so we talked about the facilities that we had in place sort of at our distribution and sort of repair centre before. So a customer would effectively notify us that there's a problem with that device, would send that device effectively back into us, where we need to do repair or effectively replace that device under the terms of the warranty.
Okay, thank you. And probably time for just a couple more. Steve, I know sometimes we often get asked this question, but have you thought of changing your name to reflect your increased focus towards tech?
Yeah, so Ian and I, over the years, it's the question probably we've been asked more than any other, and we have a little klaxon goes off, at least in our head, when we're asked the brand question. Look, I guess the truth is, if I was back in my garage 16 years ago and thought we'd become the UK's biggest mobile phone recycler, we wouldn't have gone with MUSICMAGPIE. We are where we are. We're comfortable with the brand name, whether it's called Snickers or Marathon. People enjoy the chocolate bar. I think 50% of the UK population have heard of Magpie. They understand who we are and what we do, that we're not just a CD and DVD business anymore. So I think very comfortable with the brand. I think changing the brand name now would represent much more of a risk in terms of domain authority and trust in the brand, etc. generally than it would bring in terms of a benefit. So no, we don't lie awake worrying about that one at night too much. Although some people may know this story, we did when we took the brand to the US and found out that they didn't have magpies. After 3 months of operating MUSICMAGPIE, they have Blue Jays, but they don't have magpies. MAGPIE isn't even a word. And when I asked them, our first colleagues over there, what did they think the cartoon magpie was on our website, they said, is it a penguin? So Music Penguin, I don't know whether we got that registered or not, but no, it's Declutter is the brand over there because they didn't have magpies. But we'll stick with the magpie over here and with music in front of it.
Okay, I'm just conscious of time, so perhaps this can be the last question. So, any plans to move into Europe, and is there any competition?
Perhaps I'll take that one. No immediate plans. We do distribute and sell into Europe via the platforms mainly, but no immediate plans to look at sourcing in the EU or indeed anywhere else in the world other than, look, we think we've got, two very significant territories in terms of the UK and the US. I mentioned before the part that the US plays in the business. Obviously, when we think strategically even wider about where this business goes, you think about product mix extension and territory mix extension. There's lots and lots to do within the 4 grids that we've got at the moment, the 4 boxes in the grid of UK, US, tech and media, with lots and lots going on in the UK tech space at the moment. So no immediate plans. If I may, Matt, I have noticed one that just said something about the logistics challenges and Royal Mail in December, and I think it is perhaps just worth touching on that specifically, and then maybe just closing on that, because why didn't you switch from Royal Mail? I think it was a preemptive question actually during December. We referred to in our update yesterday, we did use the word challenging because there was aspects of Q1 which frankly were challenging. I think whether you're an online retailer, small or large, Royal Mail disputes did cause us some problems. And yes, we did move, as did everybody else who use Royal Mail, and all the other logistical providers really struggled. Their networks collapsed in some instances. So we did consider alternative ones. But our trade during December, in those vital gifting days between the 10th and the 20th, you saw the graphs, Matt, where we would historically be doing bigger days, we did more modest days this year because people shopped on the high street. I think it was consumer perception and self-referencing for a moment. We do all our shopping online. We went back to the shops to guarantee that you went home in your hand, on the bus or in your car, back from the shops. So online, I think, generally was impacted by that. But that said, just to be really clear on what we said yesterday, we did not guide our numbers down yesterday. We reflected on the fact that there had been, in particular, that challenge in Q1, but we did not guide our numbers down. We're very confident on the strategic growth aspects that we've talked about. What we try and do more than anything is the graph that Ian put up that showed the extrapolation of where our rental income and EBITDA contribution is going and the direction of travel. And if we keep that growing in the right direction, we've taken some considerable pain actually in terms of sacrificing and substituting day one sales, but we want that rent to continue through. That will continue to drive our enhanced relationship with consumers and our numbers, and that's transformational. But yes, it was only appropriate for us yesterday to refer to the fact that we had that short-term logistical challenge in December.
That's great. Steve, Matthew, Ian, thank you so much for being so generous with your time and taking those questions you can from investors. And thank you to all the investors on the call for your questions. And we will make all the questions available post today's meeting to the company. Steve, I know investor feedback will be particularly important to you and to the rest of the team, and I'll shortly redirect those on the call to give you their thoughts and expectations. But I wonder, before doing so, if I may, Steve, just ask you for a few closing comments, after which I'll ask investors for their feedback.
Yeah, absolutely. I think just to reiterate again, very clear focus on our strategy going forward. Buy more, sell more, rent more. We have to balance that appropriately in terms of short-term performance of our sales versus the medium-term. I've stopped myself saying long-term because it's medium-term opportunity to really continue to grow that rental graph. And if I were sat in your shoes, and remember, I am the biggest single shareholder here, it's that rental graph that I look at every time. We're building something really quite significant with that. At times, investors who are less intellectually invested or time invested in us just sort of think, is that a buy now, pay later, or what is it? think about what it is, how we're doing it. We've taken some pain in terms of substituting those cells out, but we're building something of very significant value to the customer and to our financial performance. And that's, I guess, the key message, as well as our passion and our enthusiasm that we have for our own business. You'd expect us to have nothing less. We don't. We're very excited about the prospects of our business in the months and years to come.
That's great, Steve. Thank you once again, and to Ian and Matthew for updating investors this afternoon. Can I please ask investors on the call not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Music Magpie PLC, I would like to thank you for attending today's presentation, and good afternoon to you all.